Markets may be underpricing the risk of a Fed rate hike later on this week. If that's correct, it could be enough to trigger a bullish breakout in the US dollar. Futures currently assign a 40% probability of a move. Now, I can understand why traders remain reluctant to price in a greater chance of action. Under previous Fed leadership, significant policy moves were usually delivered alongside updated economic projections rather than at intervening meetings like this one. But this isn't the old Fed. Since the June FOMC, traders have steadily shifted towards pricing the risk of a hike after policymakers delivered an unequivocally hawkish message that caught most of the market by surprise. But even after that repricing, traders still aren't convinced that the Fed will act this week. And that brings me to what I thought was the best question at the June FOMC press conference. Wall Street Journal reporter Nick Timiraos essentially asked Kevin Warsh, if the Fed is so serious about restoring price stability, why didn't you raise rates? In other words, at what point do you stop talking about restoring price stability and actually do something about it? It was a great question because here we are 6 weeks later and we're still asking the same question as we have been doing for years. Inflation remains well above target, particularly across underlying measures and in services. If the Fed is serious about restoring inflation credibility, it's becoming difficult to argue that simply waiting will achieve that objective. It's been more than 5 full years since it hit its apparent 2% target. For the US dollar, the implications are clearly important. Markets already expect the Fed to remain hawkish with a full 25 basis point hike priced by September and more than 2 over the next year. That means a hawkish hold could still deliver support for the dollar, particularly if several policymakers dissent in favor of a hike. It would reinforce existing hawkish expectations rather than undermine them. Only an unlikely dovish hold may be enough to deliver meaningful downside for the buck. Technicals certainly point to upside risk as well. The US dollar index on the 4-hourly timeframe has been calling beneath resistance for several sessions, refusing to give back gains despite a sharp fall in energy prices that, at least earlier in the Iran war, would have sent it sliding. That's a constructive signal, suggesting bulls remain in control. If the Fed delivers either a rate hike or an unmistakably hawkish hold, this structure opens the door for a potential bullish breakout. The initial upside target would be a retest of the June 24 high at 101.80, with 101.98, which was a swing high set back in May, the next after that. Best of luck with your trading. I'll catch you next time.